Good morning. Why did the Fed just inject $29.4 billion in liquidity, and what does that mean for Bitcoin? So the Federal Reserve recently injected 29.4 billion into the US banking system, its largest liquidity boost since 2020. And while this move calms short-term funding markets, it's not the same as quantitative easing or CE, and it carries very different implications for investors and the broader economy. What happened? So the Fed used its standing repo facility, or SRF, to provide short term loans to banks and primary dealers. This helps maintain liquidity or cash availability when reserves run tight, especially as quantitative tightening, or QT, and Treasury cash buildup have pulled money out of circulation. So, why does this matter? Well, the operation wasn't meant to stimulate markets like QE, but rather to stabilize short term interest rates and prevent liquidity stress. And by doing so, the Fed ensured smooth functioning in overnight lending markets, which is critical for banks' day to day funding needs. And how this will impact Bitcoin and other risk assets. Well, Bitcoin and other risk assets tend to respond positively to liquidity injections, and the added cash support market confidence and lowers short term rates. But since this move was temporary and not reversible, it's not expected to spark a major rally. Still, the injection signals the Fed's willingness to act if liquidity tightens, a positive backdrop for risk sentiment overall. And the bottom line is the $29.4 billion injection was a short term liquidity patch and not a stimulus package. It helps avoid potential funding stress that could ripple through the financial markets and, by extensions, offers mild support to Bitcoin stability. It's a deep topic, but that is it for the day, my friends. Hope you have a good one.